Ladies and gentlemen, let me start with a question that should make every one of us pause. What happens when the strongest institutions in the world suddenly need emergency help? What does it mean when banks quietly rush to the Federal Reserve for $17 billion? Not for growth, not for innovation, but simply to survive the pressure. This is not just a number on a screen. This is a signal, a warning, a message from the financial system itself that something deep is shifting beneath our feet. We are witnessing a moment where confidence is being tested, where the old assumptions of endless liquidity and perfect stability are being challenged. When silver short positions implode, it is not just traders who feel the pain, it is the entire ecosystem that feels the shockwave. Margin calls ripple through funds, banks tighten their grip on credit, and suddenly, the invisible machinery that powers the global economy begins to creak. History teaches us that markets do not collapse in noise alone. They collapse first in silence, in small cracks that most people ignore until they become impossible to overlook. But here is the opportunity hidden inside this uncertainty. Disruption is always the doorway to transformation. Every financial reset in history has cleared the path for new systems, new leadership, and new ways of thinking. The question is not whether change is coming. The question is whether we are prepared to adapt, to learn, and to position ourselves wisely. Those who understand risk, respect cycles, and remain disciplined in chaotic times are the ones who don't just survive crises, they emerge stronger from them. This moment demands awareness over panic, strategy over emotion, and clarity over fear. It demands that we stop chasing illusions of easy profits and start building resilience, knowledge, and long-term vision. Because markets will rise and fall, institutions will expand and contract, but the people who invest in their understanding will always hold the true edge. So as we watch banks seek safety and markets send warning signals, remember this: uncertainty is not your enemy, ignorance is. The system is changing, the game is evolving, and those who choose to stay awake, alert, and adaptable will shape the future rather than be shaped by it. And that is why this is not the end. This is the beginning of a new financial chapter, and you get to decide how you will write your part in it. When banks turn to the Federal Reserve for emergency funding, the act itself becomes a signal to the market that liquidity conditions are tightening, regardless of what official statements may suggest. Liquidity is the oxygen of the financial system. It allows institutions to settle payments, roll over debt, meet margin requirements, and continue lending to households and businesses. When that oxygen becomes scarce or uncertain, even temporarily, the system responds with caution. What makes this moment compelling is not the size of the number alone, but the reason behind it. Banks are not borrowing because money is cheap. They are borrowing because access to private funding is becoming more fragile, more selective, and more expensive. In stable environments, banks prefer to borrow from each other in wholesale markets or issue short-term debt because it carries less stigma and often better pricing. Turning to the central bank is typically a last resort, a backstop designed for moments when normal market plumbing begins to clog. So when that backstop is used, it quietly reveals that something in the funding chain is under stress. It tells us that counterparties are becoming cautious, that risk tolerance is shrinking, and that trust, the invisible currency of finance, is being repriced. The hook here is simple, but powerful markets do not run on money. They run on confidence, and confidence is what is being tested. This shift matters because liquidity stress rarely stays contained. When banks feel less certain about their own access to funding, they become more conservative in providing funding to others. Credit standards tighten, loan growth slows, and financial conditions become more restrictive even without any formal change in interest rates. Businesses suddenly find it harder to finance expansion, consumers face stricter lending terms, and investment decisions are postponed. What starts as a technical adjustment in interbank markets quietly becomes a macroeconomic force that shapes growth, employment, and inflation. There is also a behavioral dimension to this process that is often underestimated. Financial institutions are forward-looking. They respond not only to what is happening, but to what they fear might happen. If volatility in markets rises, if asset prices become unstable, or if losses emerge in specific sectors, banks adjust preemptively. They build liquidity buffers, reduce risk exposure, and preserve capital. These actions are rational from an individual institution's perspective, but collectively they amplify tightening across the system. The hook here is that safety, when pursued by everyone at the same time, can unintentionally create the very slowdown everyone is trying to avoid. Central bank facilities exist precisely to prevent this dynamic from spiraling out of control. By providing liquidity against collateral, the Federal Reserve aims to stabilize funding markets, reassure participants, and prevent temporary stress from becoming a structural crisis. However, the mere activation of these tools carries informational value. It tells investors, firms, and policymakers that conditions are not as smooth as they appear on the surface. It signals that the financial system is moving from a phase of abundance to a phase of caution, from expansion to preservation. This transition reshapes incentives throughout the economy. Risk premiums rise, speculative positions become harder to sustain, and capital flows shift towards safety and quality. Over time, this process reallocates resources away from fragile structures and toward more resilient ones. The deeper message is that liquidity stress is not just a problem to be solved, it is a mechanism through which the system corrects excess, disciplines risk-taking, and resets expectations. And the question that truly matters is not whether liquidity will tighten or ease, but who is prepared for the shift when it happens, and who is still positioned for a world that no longer exists. When a concentrated position in a single market unravels, it rarely stays confined to that market alone. The implosion of large silver short positions is a textbook example of how localized stress can transmit through the financial system, moving from commodities to derivatives, from hedge funds to banks, and from balance sheets to sentiment. At first glance, a short squeeze in silver may look like a technical trading event, but beneath the surface it is a liquidity event, a risk event, and a confidence event all at once. The hook is that modern markets are not connected by prices alone, they are connected by leverage, collateral, and shared psychology. Short positions are built on borrowed assets and borrowed time. When prices move sharply against those positions, traders are forced to post additional collateral or close positions at a loss. This creates immediate demand for cash and liquid assets, which are often raised by selling other holdings. As those assets are sold, their prices come under pressure, triggering further margin calls elsewhere. What began as a disruption in one commodity market becomes a chain reaction across asset classes. The real transmission channel is not silver itself, but the financing structure that supports speculation in silver. This dynamic is intensified by the central role of derivatives and prime brokerage relationships. Hedge funds and trading firms typically finance positions through banks, which means banks are exposed not only to market movements, but to the funding stability of their clients. When clients face sudden losses, banks must reassess counterparty risk, adjust collateral requirements, and in some cases reduce exposure altogether. This tightening feeds back into markets by reducing liquidity and increasing volatility. The hook here is subtle, but powerful. Volatility is not just a result of stress, it is a mechanism through which stress spreads. Investor behavior amplifies this process. As headlines turn negative and price swings increase, risk appetite declines. Portfolio managers rebalance away from volatile assets toward perceived safe havens, reinforcing price movements that began for technical reasons. Algorithms and risk models, designed to reduce exposure when volatility rises, execute the same logic automatically and at scale. The result is synchronization, many actors responding to the same signals at the same time, accelerating market moves beyond what fundamentals alone would justify. This spillover has real economic consequences. When asset prices fall and uncertainty rises, firms delay investment, households reduce discretionary spending, and financial conditions tighten. Credit becomes more expensive not because policy has changed, but because risk has been repriced. This is how financial market turbulence becomes macroeconomic friction. The hook is that what looks like noise in trading screens quietly reshapes decisions in boardrooms, factories, and homes. The global nature of markets deepens the transmission effect. Capital flows move across borders at high speed, so stress in one jurisdiction can quickly affect currencies, bond yields, and equity markets elsewhere. A disruption in silver trading in one market can influence risk premiums in emerging markets, funding costs in Europe, and investor sentiment in Asia. This is not contagion in a medical sense, but in a financial sense, interconnected, balance sheets transmitting shocks through shared exposures and synchronized behavior. What this reveals is that market stability is not about the absence of shocks, but about the system's ability to absorb them without amplification. When leverage is high, liquidity is thin, and confidence is fragile, even a relatively small disturbance can produce outsized effects. The deeper lesson is that modern finance is less like a collection of independent markets and more like a single, tightly coupled system. When one part vibrates, the entire structure feels the movement, and the question is never whether the vibration will travel, but how far, how fast, and with what force. Risk repricing is the moment when markets collectively wake up and realize that yesterday's assumptions no longer hold. It is not announced, it is not scheduled, and it is rarely gentle. It emerges when investors suddenly demand higher compensation for uncertainty, when volatility becomes information rather than noise, and when capital stops flowing freely and starts asking questions. The hook is that markets do not change their mind slowly. They change it all at once, and then pretend it was obvious all along. In periods of stability, risk is systematically underpriced. Low volatility, abundant liquidity, and positive momentum create an environment where leverage appears safe, spreads appear tight, and downside scenarios are mentally discounted. Models are calibrated on recent calm, and recent calm becomes the assumed future. This is how risk accumulates invisibly, embedded in balance sheets, derivatives, and expectations. The system looks stable precisely because it is becoming fragile. The hook here is that comfort is often the most dangerous signal in finance. When a shock occurs, whether through a sudden price move, a funding disruption, or a policy shift, that hidden fragility is exposed. Investors begin to reassess probabilities that were previously ignored. Losses force sales, volatility rises, and correlations across assets increase. What was once diversified begins to behave as one. Risk premiums expand, credit spreads widen, and funding costs rise. This is the repricing mechanism in action. Not a technical adjustment, but a psychological and financial realignment of how uncertainty is valued. Margin calls play a central role in this transition. They convert abstract risk into immediate cash demands. A trader may believe in the long-term logic of a position, but a margin call does not care about long-term logic. It demands liquidity now. This forces liquidation at precisely the wrong time, locking in losses and pushing prices further away from equilibrium. The hook is that forced selling is not a decision, it is a process, and once it starts, it feeds on itself. Credit markets respond in parallel. Lenders, observing higher volatility and losses, tighten standards and reduce exposure. Borrowers face higher rates, stricter terms, or outright denial of funding. This constrains economic activity not through policy, but through caution. The economy slows not because demand disappears, but because financing becomes selective. This is how risk repricing in financial markets becomes a macroeconomic event. Behavioral dynamics intensify the shift. Humans are loss-averse and narrative-driven. Once a story of instability takes hold, it spreads faster than any data release. Investors rush to align with the new narrative, even if the underlying fundamentals have not changed proportionally. Algorithms amplify the same logic, reacting to volatility, correlations, and price momentum in predictable ways. The market becomes a feedback loop, where perception drives price and price reinforces perception. This process is not inherently negative. It serves a corrective function by discouraging excess, reallocating capital, and restoring a more realistic pricing of uncertainty. The danger lies not in repricing itself, but in its speed. When adjustment happens gradually, systems adapt. When it happens abruptly, systems fracture. The hook is that resilience is not about avoiding change, but about surviving the speed of change. What ultimately emerges is a new equilibrium, where leverage is lower, spreads are wider, and caution replaces euphoria. The system becomes more stable precisely because it has become more conservative. But that stability is earned through discomfort, losses, and resets. Risk repricing is the market's way of remembering what it chose to forget. That uncertainty never disappears, it only waits to be acknowledged. Systemic fragility is one of those concepts that rarely makes headlines until it becomes impossible to ignore. It is the quiet vulnerability embedded in financial institutions that looks invisible during periods of stability, but surfaces dramatically under stress. When banks tap the Federal Reserve for emergency funding, it is not just a matter of liquidity, it is a window into the structural weaknesses that lie beneath apparent strength. The hook is that the strongest institutions can appear invincible until the moment they reveal they are not. Fragility is built over time, often unintentionally, through leverage, interconnected exposures, and reliance on short-term funding. Banks and financial institutions optimize for profit under normal conditions, stretching their balance sheets, minimizing capital buffers, and using complex financial instruments to enhance returns. These practices work beautifully when markets are calm, asset prices are rising, and credit is abundant. But the very structures that amplify profits in good times also amplify risk in bad times. Small shocks can cascade, turning minor losses into systemic threats, and the appearance of stability can mask deep vulnerabilities. Interconnectedness is a key driver of systemic fragility. Banks, hedge funds, and other financial actors do not operate in isolation. They lend to each other, hold each other's securities as collateral, and engage in derivative contracts that link their fortunes together. When one institution experiences stress, it transmits through these channels quickly. A single balance sheet problem can morph into a liquidity shortage, which in turn pressures counterparties, leading to margin calls, forced asset sales, and rising volatility. The hook is that in highly interconnected systems, the weakest link defines the resilience of the whole. Behavioral factors further exacerbate fragility. Financial actors are forward-looking and reactive. They monitor risk not only based on what has happened, but on what could happen. Rumors, market signals, and sudden losses trigger defensive actions, hoarding cash, reducing lending, and liquidating risky positions. Individually rational actions collectively magnify stress. This is the paradox of fragility. The measures taken to protect individual institutions can unintentionally destabilize the broader system. The hook here is striking. What protects one entity can imperil the system, and what imperils the system often surprises everyone. Regulatory structures and central bank interventions play a dual role in fragility. On one hand, regulations such as capital requirements and stress tests are designed to make institutions resilient. On the other hand, the very presence of safety nets can encourage risk-taking, as institutions may assume that extraordinary support will be available in crisis. Emergency Fed funding is a clear illustration. While it prevents immediate collapse, its use signals that systemic stress exists and that vulnerabilities were underestimated. The hook is that safety mechanisms, while essential, can mask hidden weaknesses until they are tested under extreme conditions. Finally, systemic fragility is a mirror reflecting human behavior and finance overconfidence, short-termism, and underestimation of rare but impactful events. It shows that financial resilience is not just about numbers on a balance sheet, but about adaptability, foresight, and the ability to absorb shocks. Every emergency borrowing, every sudden liquidity need, and every margin call is a reminder that beneath the smooth surface of markets lies a web of delicate interdependencies. The hook is that the system's stability is earned in calm times, but truly revealed when it is stressed. And those who understand this hidden fragility are better equipped to navigate the next shock. Cyclical economic resets are the moments when markets pause, recalibrate, and realign, often in ways that feel sudden, disruptive, and even frightening. They are not arbitrary. They are natural responses to accumulated imbalances in financial systems, leverage, and investor behavior. The hook here is that what feels like chaos is actually a mechanism of renewal, a process through which inefficiencies are cleared, risks are repriced, and capital is redirected toward more sustainable and productive uses. These resets are the economy's way of enforcing discipline when optimism has outpaced reality. In every market cycle, periods of expansion tend to sow the seeds of contraction. Credit becomes abundant, asset prices inflate, and risk is systematically underestimated. Institutions and investors chase returns without fully accounting for downside vulnerabilities, creating structures that are highly sensitive to shocks. When a disruption occurs, whether through a sudden price move in a key commodity, a liquidity shortage, or a policy shift, it acts as a trigger that forces recalibration. The hook is that the same mechanisms that amplify growth during the boom phase amplify correction during the reset phase. These economic corrections are multidimensional. Financially, they involve the unwinding of speculative positions, adjustments to leverage, and repricing of assets. When silver shorts implode, for instance, the immediate effect is a transfer of wealth between market participants, but the broader effect is a reallocation of capital towards safer, more resilient positions. Banks tighten lending standards, investors reassess portfolios, and risk premiums rise. Economically, this slows credit growth, tempers investment, and encourages more careful decision-making across sectors. The hook is that what may appear as market panic is often a strategic clearing of excess, a natural pruning that prevents deeper structural damage later. Behavioral dynamics are equally important in these cycles. Confidence and perception drive financial behavior, and when confidence wavers, markets respond with speed and intensity. Herd behavior, algorithmic trading, and preemptive risk management amplify the movements, making the reset appear larger than the underlying fundamentals might suggest. Yet this amplification serves a purpose. It forces attention, compels reassessment, and ensures that mispriced risks cannot persist indefinitely. The hook is that volatility is not merely a symptom of instability, it is the language through which markets communicate that a recalibration is required. Systemic consequences extend beyond immediate financial markets. When risk is repriced and liquidity tightened, businesses face higher borrowing costs, households experience reduced access to credit, and investment projects are delayed. These changes feed into the broader economy, slowing growth and prompting more cautious decision-making across industries. The reset operates like a natural filter, reallocating resources from speculative or fragile structures to those that are more robust and better aligned with long-term economic realities. The hook is that resets are both corrective and constructive, shaping the economy for durability rather than short-term gain. Historically, cyclical resets have paved the way for new growth and innovation. Crises clear capital from weak or inefficient positions, free up resources, and create space for stronger, better capitalized actors to emerge. They remind policymakers, investors, and institutions that growth without discipline is unsustainable. The hook is that while resets are uncomfortable and often painful, they are the engine through which resilience, efficiency, and sustainable opportunity are forged, ensuring that the system does not simply accumulate fragility over time without correction.